So if you're trying to trade the fair value gap and you keep losing, keep watching to see the correct way you should be reading these gaps in the market. Now, whether you class it as the fair value gap, I class it as an imbalance zone, you can also class it as a liquidity gap in the market. There's a correct way to trade these gaps. And if you're trying to trade them on every single gap in the market and you're losing, then this video is exactly what you need to be watching. So we're going to have a quick look over here. Yes, this will be in hindsight because I already know the price action, but I want to show you step by step how you read these gaps. So you can't trade every single gap. By this, I mean, you're going to find that these imbalance zones, these gaps left over, will leave orders and they're going to be filled and used to either push the market through when they're filled and absorbed, or you're going to find they're going to be filled to push the market away. So if we take this example right here in the market, we can see that this gap didn't work. Okay, you can see the market pulled up and straight through. Absolutely no buying pressure coming out of this gap. So how do we use these gaps successfully? You need to understand market structure. You need to understand supply and demand techniques. But let's go through how you can read these gaps, okay, these fair value gaps correctly on a chart. So let's go to this area. Right here on the chart, what do we have? We have one gap here we can mark. Then on the way down, we have absolutely nothing else except for this swing high. So right now, we do have some internal structure here as well, which I could mark off. We're going to pull back. So we can mark this off as a high. We go forward price. Okay, we've broken structure here. Now, one thing that you may not understand about gaps is that even when we create this move like this in the market, this is a potential gap. And we can very often see price want to pull back in and then continue on its way. So the gap, how is the gap actually formed? Well, we're going to use this as an example. A gap is formed when we see the candle high before this candle continues to be bullish. Now it can be a bearish candle here, as you can see this gap. And then we look for the next candle to create a higher low to leave a gap inside this bullish candle. So we move one candle. This has not happened, but look how this candle has pulled all the way back and we've held at this zone. Now, potentially we could see a continuation higher if we do not see a close through this level to start with. So we've closed through and wicked lower. Now, this could be getting orders out of this wick here in the market. Let's continue forward and you can see we've wicked and we've pushed through eventually. So now we have a break of structure here. Understanding structure in the market, we have a break of structure, pull back, potential continuation. So this wasn't a great example because there wasn't a gap formed. Let's look at this area. Again, we have this potential gap left over. And we have to recognize we're coming into this gap here. So we need to see this gap removed, okay, for continuation for this gap to work. So we move higher. So now we can see that we created this new gap. Now we want to see this closed through this gap or potential pull back into this gap. Why? Because now we have a valid break of structure here. So we had this break of structure here to the upside. So understanding your structure is key. We had a break here to the upside, pull back, and a breakout. Now, if you're not sure about anything to do with market structure, there are some awesome videos in the channel. We have this potential gap left over. Now, when we're using a gap, we're looking at 3 levels for a potential entry. The high of the gap, the 50% of the gap, or the low of the gap on a bullish move. Hey traders, we'll get back to the video in just a moment, but I wanted to give you a gift for hanging out with me today. I want to give you access to my Telegram community. This trading community will share my chart markups and give you access to my trading strategy. But it's more than just a community. You're going to have some actionable steps to accelerate your growth. We're hanging out with other like-minded traders, all looking to improve their trading. And it's free as my gift to you. So just hit the link above now to join the Telegram community. Now back to the video. Now on a bearish move, we're looking at the high, the 50%, and the low of the gap. So as you can see here, price came back into this gap. Let me just show you. The gap originally was here of the high of this candle. We came back, we held, okay, at the low of this gap, and that pushed price down. That's how you understand the use of these gaps. Now, the market's now gone up and we've closed through the 50% of this gap. This tells me we will go for the high of the gap. Let's just go forward one candle. Now we've pulled back after coming towards the high of this gap. Okay, so we haven't quite touched the high yet. We've pulled back into this gap. Now look, we closed the 50%, wicked the low of this gap. Now, one thing I need to tell you is when we're trading these gaps in the market, if we ever close through the bottom of this gap, it's invalidated and you expect to move lower. If we only wick through and it holds, we'll expect to move higher. So from here, we've wicked through. We are going with this trend. We are now bullish of this structure. So I expect to see here a potential continuation to remove this gap and to go for this high. So there is our continuation. We've held this gap. This gap has done its job for continuation. Now there's a reason why this one has worked, because we're going with structure. This gap created the break of this structure. The same with this gap. This created the break of this structure to the downside. Now we've also removed this gap, which now indicates we will go for this swing high. And that's how you can start to read the fair value gap, the imbalance zone as I class it, or the liquidity gap in the market. All they're doing is we're finding those orders left over. So we continue forward and there we go. We wick the high. That's how easy it is. Now what this is part of a potential swing move with our internal structure within. Understanding your structure is key. So as we continue up here, have we left another gap? We have just left a very small gap here in the market. Okay, so a great gap there. Potentially we see a push away. We want to see it close through this high next. So there, we've got to close through this high. That is qualifying a continuation. Now, we have another gap we can draw here. So as the market moves higher, we can draw out these gaps left over. And another continuation. So you can see how I'm drawing these gaps out. And when we're using this, we need to understand as well, where's the move coming from here? The move is coming from this low to this high. So we want to see a pullback at least to the 50% or lower when we're looking for potential trade. So this gap here to me will not work. And that's how you understand these gaps. Now we've got a lower high, so a potential pullback. So you can see we've wicked through to test this 50%. If we see a continuation here, perhaps on lower time frames or break a structure, then that could give us an entry to go long back for this high. But we need to see what happens on this next candle. Now we've wicked through to retest this low. Now remember, what did I say? If we mark this out, we're not even got to that 50%. So for me, I would not even be looking for a trade here. I want to see a pullback to this gap or even this gap here. Now we also have here is an area of demand. So potentially a pullback to this gap and this gap wicking through to the demand is an ideal area for potential trade. It's going to be the swing pullback, and that's how we look at using these gaps. This gap is a potential reversal. If we can see it close down and a close through the 50%, we know we should remove this gap. So we wicked up, swept the high, and now we've closed through, again sweeping through the bottom of this gap. Now we should take this gap. And we just see, and we've closed through. Now look at this. We've actually wicked through this gap as well. So this gap has now been removed. It's done its job. And very often we're going to see a new gap created once we remove one. So we can see that we're going to create this new gap here, potentially. So how these gaps can work is we can see a pullback, okay, within this gap, and then a continuation lower towards the demand. That's how we can look at these gaps. So we've got to pull back towards the 50%. We've closed and removed this gap. We've now wicked through this gap into the demand zone. So this now tells me potentially we could see another move higher for this week high. We've seen our pullback to demand. And this is where we start looking for those trades on the lower time frames. So understanding these gaps in the market is key where they are located. So now we actually move this gap to here. And then we've got to close straight back up. That's a good sign that potentially the market will now go for this high. And we've actually closed for the 50% of this gap. So I'd expect to see the run through the high. And removing this gap, we have nothing else here to the left. So then we expect this high to be run. So we hold the gap. Now we've closed through. This has now done its job. It's been removed and it shows us the continuation for the swing high. We could see a pullback yet. Okay, take out some of these lows, but we should see a continuation for the high. And there you have it. So hopefully you can start to see the key area of these gaps. Now, of course, if there's anything so far we've gone through in this video you're not sure about, just leave a comment below. I will answer every single question. But now we can see we've just closed through this high. That's a continuation. So now we have a new swing to the upside. So our structure continues to be bullish. So we have even this swing move here and a pullback continuation. That's what we're now looking at. And we have our internal structure as well. So let's see what happens. Now we have a potential new gap. So we can mark out something here like this. Now we could see the market pull back into these gaps, just like we saw on this candlestick down here. When we had this candle like this, it was a potential gap forming in the market, and we see we held this area. So we don't have to even look at the gaps after they're formed. We can actually look at these areas before they even form. That's how someone really understands how to trade these gaps in the market. Now, if you've got to this point and you're really enjoying this content, then leave me in the comments. I know how to trade gaps. All you need to write is I know how to trade gaps. Nobody's going to know what that is about unless they've got to this point in the video, just for a laugh. Now, when we get to this point, we want to see a pullback into this gap continuation. That's what we're looking for. Okay, there you have it. Okay, that's how you can identify these gaps before they even happen. Now we've actually fully closed through, potentially look for that continuation higher. And there's a continuation higher. So again, we then have a new potential gap here is forming. Now our swing is now obviously going to be from this low currently to this high. So again, we need to come back to the 50% area, but we don't have any gaps there. Let's continue forward. Again, look at this, pull back towards the 50% continuation of that gap. Now we've actually left an actual gap in the market, and we can draw out a new gap potentially here. So again, you look for the pullback continuation. And we didn't really get much of a pullback. We just a tiny pullback. Remember, like I said, the highs and the lows and the 50% can be used as a gap. So we have this gap in the market, and look at that move away now. Now, this is where many traders are going to start to see this big gap. Okay, I think, okay, this is where we can look for pullback continuation. But what you now learned with understanding structure in the market, would you want to be trading that? Let's have a look. Where is our current structure? If this is a pullback from here, there's our 50%, which means we're not going to even think about a trade until we come to this gap here. And even below that, we do have a very small gap left over just there. I'll draw that out anyway. So a very small gap. So to be honest, all these gaps, not even interested in. Let's just see what actually happens. So we've continued down. Okay, not quite got to the 50%. We closed the first level, which is the high. Okay, now we've wicked up, we've swept the high. That's an indication of a potential bearish move when we close this 50% level. We expect the full fill of this gap next and then potentially go lower. And there we have it. We go lower, we totally take out that gap. On the way down, just so you can see, we do have a new potential gap forming. And very often you're going to see a gap form. We do have a small gap there as well. Okay, so this gap here, I can just draw. This is the gap what removed this gap, which we had this one here. This fair value gap, liquidity gap, imbalance zone, whatever you want to refer to it as. Myself, I look at it as imbalance zone. This is all being removed now. And now potentially this one will be removed on the next candle, because look at how this wick went all the way down to fill this imbalance. There we have it. So now we can see that this one has been removed. And now just remove that. And now we can see this one basically has just about pipped through as well, and that's been removed. And then we've wicked through this last gap. If this gap does not hold price here, then I'm expecting price to go to take out the low of this range. We work in ranges, okay? This is our current trading range. This is how we look at trading gaps in the market. Not all that other nonsense. I see so many people showing you trading the gap like this. It's not the way you read these gaps. They're used for directional bias, looking for those areas where those orders are going to be absorbed or they're going to continue that move. So here I expect to see a potential pullback into this gap and a lower move. That's what I'm expecting to see. Again, we do have another potential gap. Not much there, no, there's no gap actually. Let's go forward. Now we've got a continuation. And you can see we've left this potential move here and this gap here. Okay, we did wick up. So you can see we've got a new gap here, new gap. Okay, now we removed this one. What does that now tell you? It tells you that the market is most likely going to reverse this trend. This current trend to me is most likely going to reverse. Yes, we do have a potential area of demand here. But now all those orders left over have been completely absorbed by this move down. I'm seeing a bearish move here, leaving new gaps. Okay, so I expect to look for continuation to the downside. Yes, structure is bullish, but reading these candlesticks on a lower time frame, I guarantee your structure will now be bearish. So we hold, okay, at this gap. Now it's not an actual gap left over, it's a gap in live conditions. So we could pull back up next candle, and we do. So we held at this gap and we've pushed through. So now we pushed through this gap. We could potentially now come up to this one here. Let's just see if we go up to that gap, moved up higher, and we've wicked into it. Okay, so look at that, nearly the 50%. That is how you read liquidity gaps. That is how you read the fair value gap. That is how you read the imbalance zone. Understanding this is key. Now look, on an internal structure here, we actually broke this low right there. So we expect a continuation down. Again, there's nothing in here. There's only one thing I expect the market to go for next, is this low, and then this low. If we close this low, we go for this low. Okay, so what do we have here that I didn't draw? We have a potential gap in the market. So we've held at this gap. Okay, we do have a leftover gap above, but I wouldn't expect the price to come back to that yet. Potentially, I look for it to hold at this gap. We've held, and we continue to be bearish. So you can see how this works. We have a new potential gap forming. This one was completely taken. Now I'm showing you a different way to trade these. You wouldn't have seen this anywhere else before. Continuation down. Look, we pull back to the 50%, continue down. We have another potential forming gap. Okay, we do have a leftover gap. Now we're going towards this low. We wick through. Okay, we've wicked through and we've actually wicked up to the 50% of that gap and we held. Now we have this gap left over. Next candle, we've closed this gap, removed it. What does that now tell me? Potentially we're going to go for this gap and then we could look to run this low. If we run this low, we will take out the range low of this swing and we continue to be bearish. So looking at this, we have a current gap forming, okay, to the upside, very small one. So we can see a pull back into this and a push up for this high. So there you go, the pull back into this gap and a push higher. Now we have nothing else, so we could see another pullback continuation again into that area here, and then potentially the close of this low. So we spiked lower. I'm still expecting a pullback into this. We need to pull back to get those orders to push the market lower. Now we could sweep this high and into this gap still. I still don't see this going down yet. We could, but I want to see it take out this high. So what do I mean? We have a swing high left over here, which I'll class as potential sweep. So I'd like to see it sweep this high into this gap around the 50%, continue low, or the low or the high. As long as we wick through into this gap, gives me those orders. Okay, so there we have it. Sweep above the high, 50% of the gap. We haven't quite closed this level, but we've closed at it. So we should take that. Closed at it. And again, we've wicked through, but we're still going lower. Look, we're going to remove it. Continue higher. Okay, we could come back more to this gap. Let's see. Now we've turned back down. So we made a lower high. Still need to see this close through. Continue. Okay, so we wicked through again. Didn't quite come back to this gap. And we wicked through again. Remember, we're still bearish here. Got no reason to be bullish. Okay, now we've created the push down, closing through this level. Now we've taken out that low. We will remove this full swing and we'll put in a new bearish trend. There we go. We've closed it. Okay. And we'll continue hopefully. So now we can see exactly how this works. And even here, there was a gap forming right there. We wigged through, we held. Now, if we do close back above, which we have, we may go back up, take these highs. But understanding that reading those gaps, and let's just go forward. Let's see if we do go up. Okay, so we do go up and we continue back down. So what happened here was, if we just look at this, we created this potential gap. The market pulled back, we held, and then we closed back through. And we removed this small gap left over. So once we remove this gap here, on this bearish candle, we removed it. We had a bearish bias there. And then we can actually mark out this potential gap here. And what happened was, we can see the market pull back, and then we continue down. And that's how you can look at trading those gaps in the market. Don't blindly go out there trying to pick up every single gap and trade it with that market direction, because very often they will reverse the market. So as I said at the beginning of this video, if you want to follow along with those daily markups inside that Telegram community, you can join by clicking the link that's coming up right now.